Hey everybody, my name is Adam Jackson. This is the first episode of a new podcast I'm trying out. Maybe the last too. Who knows? We'll see how it goes. Anyway, for anyone who doesn't know me, just a quick introduction. I'm a serial tech founder, CEO here in Silicon Valley. Working on my fourth venture-backed project, actually. My first one was acquired by Intuit. Second one acquired by Advanced Auto Parts, and third one is a big company called Doctor on Demand, big video telemedicine company. And currently I'm working on a decentralized talent network called Braintrust. I'm also an investor in a bunch of startups, done over 100 angel investments in the last 15 or so years. Helped co-found a digital asset management hedge fund called Cambrian. And I'm an LP in probably a dozen or so tech-focused venture funds. So starting this new little show, it's going to be kind of a new format meant to help founders, other executives, people who work for startups, people who invest in startups, operators, people who are kind of in the trenches here with the rest of us. I'm going to try to do these every week. I learn a lot of stuff during the week, much of it the hard way. But I also talk to my co-founder Gabe and a lot of people on my management team and a lot of folks in the portfolio that, are going through kind of a lot of the same things. And so I learn a lot during the week, and starting the show to hopefully share some of that and be useful. So each week I'm going to go through kind of lessons learned that'll be kind of evergreen stuff. And then, maybe there'll be some stuff in the news that's interesting and that the community can benefit from. So I'll dive right in here. So anything happened this past week? I don't know. Glad I wasn't on vacation last week. I'll kind of start at the beginning. So I woke up, I think it was last Thursday morning, today's March 14th, to the news that, SVB was in trouble. I saw their in the morning, their stock was down like 50%. So, I started wiring our money out to other banking partners, and very lucky that we had other banking relationships already set up, so that there's like lesson number one: always have multiple banks when you're in business. Obviously, especially, if anything related to your business touches crypto, but really generally, in any kind of business, it's smart to have multiple relationships. We work with Bank of America, JP Morgan, Stripe, TransferWise, Brex, SVB, Silvergate. Used to work with them. But anyway, so we're able, fortunately, to get most of our cash out of there before things seized up. But then over the weekend, the Fed, the FDIC came in and backstopped the deposits, and that was really a relief. We used SVB for a lot of processing client payments to talent. We had a lot of backup banks as well, or two backup banks as well. But it was really good that the Fed kind of came in and helped there. For some reason, there's a lot of controversy around this. We could tell over the weekend that there was definitely a bank run coming for regional banks. First Republic and others. I have hundreds of friends and co-founders and investors that were really in a tough spot, and people would have missed payroll. If you don't pay your employees, you're as a director, you're held personally liable, and so that would have forced a bunch of layoffs and people missing rent and mortgage payments, and it would have just rippled through this entire region. So I get people not loving that a bank that has the name Silicon Valley in it was rescued, but all the equity was wiped out. All those folks, most likely through no fault of their own, who worked at that bank are out of a job, and that's tough. That's scary for them, and most whether they hold the executives responsible or not, hopefully they do. But I think the Fed did the right thing there. That created a sort of a domino effect on USDC, which is the crypto version of the US dollar. It's supposed to be a one-to-one backed crypto dollar. Basically, the USDC token can be redeemed for $1 at a bank. It's put up mostly by a company called Circle, onshore U.S. American regulated business. Unfortunately, they had non-trivial assets at SVB, and which created basically a run on USDC, which shut down the redemption process and cause USDC to depeg, which was a really scary thing that's never happened before. So another good lesson there, if you're in crypto or any other kind of business, like don't hold too much of your treasury in USDC. I know actually a lot of other projects that had everything in USDC, and it was a really scary existential moment for them. They weren't able to redeem out. Kind of a crazy story for us. It happened a couple of weeks ago. We use Anchorage, another one of our custody and banking partners. We have all of our treasury tokens, at Anchorage and Coinbase. But Anchorage is also a bank. A lot of people don't know that. And we were moving some USDC out over to dollars to buy treasuries just to get yield, which is a great place to park cash right now. Hopefully it will remain risk-free. We use BNY Mellon for that. It's another banking partner we have. What happened was this is like 2-3 weeks ago. Anchorage was saying, our intermediary bank for redeeming USDC is Silvergate, and Silvergate is kind of on the ropes right now. So if we do these, this large wire to redeem USDC out for dollars, Silvergate may stop it, and like your money might get held up. And this is like in February, right? So that really spooked us. So we did, it's insane. Like we did smaller wires, to get them through. And it was like one of those very scary moments well before all these failures started. So, the writing was on the wall there, certainly with Silvergate. Anyway, so, big, hard lesson learned there for a lot of us, like have lots of banking relationships for receiving money, Stripe, PayPal, TransferWise, sending money, saving money, storing money, making payroll. You really just got to have redundancy across the board there. One of the lucky things with Braintrust is Braintrust is many companies kind of running a decentralized talent network. So I just run one of the nodes, the commercial nodes for that network, and we had multiple relationships. But even if we hadn't, there are other nodes on the network that were able to process money for clients and for talent. So being decentralized there actually helped us quite a bit. It was really a relief. But I want to talk for a minute about the support system we experienced there too. Just being part of the community here in Silicon Valley, and more broadly tech. When the bank started to get in trouble on Thursday, I personally got dozens of direct messages, calls, voicemails, texts from our investors, VCs in the community that were probably also affected, but also really looking out for their portfolio companies and worried about, solvency, and worried about our employees and being able to make rent. And a lot of our venture firms really sprung into action and were offering, warm, intros to other bigger banks that could help us. And at least probably 3 or 4 of our VCs offered like direct loans, like right off their own lines of credit. One of the partners, one of our investors even offered to make us a loan off his personal line, which is, really above and beyond. I won't mention him here because I'm not sure he wants anyone to know that. But, it was really like the community really came together to sort of like make sure that, startups weren't collapsing through no fault of their own, right? Just by having deposits at the top 20, a $200 billion bank. So it was, fortunately, we didn't need any of that, but I'm sure, if the Fed hadn't come in on Monday and backstopped those deposits, like that all would have been necessary, and it would have been a really tough thing. So, and then, I was thinking about this over the weekend. It's a kind of a complex thing, and you learn a lot about the banking system by diving into what happened here. But long story short is like SVB had a bunch of deposits and assets in bonds that were long dated, and basically had yields that are much lower than the Fed funds rate, and things like mortgage-backed securities. And because they weren't required to mark them to market and really disclose kind of the liquidity of their reserves, this caused a liquidity crisis, and kind of fueled a bank run. And it's an interesting solution. Like a lot of people are like blaming regulators for not seeing this, and I don't know. I don't think I mean, that's kind of like, I saw this analogy on Twitter. Like, it's kind of like blaming DMV if there's an accident. Like, I don't know, these guys, like, they set up the rules, and there's a lot of bad judgment at SVB around risk management, and I don't think regulators can be expected to just see all this stuff around the corner. I actually think an interesting solution here would be really off the shelf technology. Like, imagine if banks had to disclose how they're managing customer deposits, reserves, disclose it publicly, put it on a blockchain if you want to, and show like what are the maturity dates of all the bonds that you're getting yield on your customer deposits from. And then you can have some open source script, like an automated system, go in and look at all this data, because it's like entrepreneurs can't be like, whether you're a tech CEO or you run a farm or a winery or some other business, like you can't be expected to like look through all that stuff and then figure out how solvent a bank might be if there's a 30% run. I mean, it's these are arcane things, but you could have some automated script that runs through and kind of gives the bank a score. Like, here's the liquidity score, the solvency score of this bank based on if X number percentages of depositors needed to redeem early, like what or right away, what would happen, like how quickly can a bank liquidate its assets, and then come up with some score, right? And I mean, it was funny, like I was talking about this with somebody, like county health departments do this with restaurants, right? They kind of like do a quick inspection, like how many roaches you got back there, how much mold, how dirty is the fryer, and they come up with a score, and then they make the restaurant tape it to their window, and then it's sort of buyer beware, right? It's like you could always eat at A graded restaurants, and you're probably less likely to get sick. Or if you're like had a few drinks, you really want that Indian food or whatever it is, and the C score is the only one that's open, like maybe you roll the dice and you go in with the C score. And I think in banking that would be like going to Wells Fargo and getting 200 checking accounts that you didn't ask for. But anyway, I think there are easy or relatively simple solutions here that can be implemented that can prevent stuff like this in the future. But anyway, so for some reason it's controversial that the Fed backstop these deposits. I don't think it is. I think they did the right thing. I know there was a bank run going for a lot of the other small regional banks like First Republic and a few others here in the area. I mean, I know hundreds of people that were just completely freaked out, and that their bank was going to be next on Monday had the Fed not acted on Sunday. So again, I think they did the right thing. Let's see, moving on. Went to New York. It was about 2 weeks ago. I was out speaking with institutional investors about crypto. Did a podcast with Frank Chaparro on The Block, talking to journalists and investors, and really just on the ground, kind of building relationships. And kind of a couple takeaways here. One, like web3 is not dead. It may be frozen. We're in a long crypto winter here, but it's certainly not dead. There's a lot of interest in fundamentally valuable projects, DeFi, decentralized marketplaces, NFTs, things that are bringing real world value. New business models that are enabled by this new technology of blockchain tokens. People not interested in speculating. People, these are sophisticated investors that are, recognizing that this space is pretty oversold, and maybe there's some actual value here. And so spent a lot of time doing that. It was really encouraging to see, have a lot of those conversations. Another kind of takeaway there for founders, a lot of you probably raised, your last round or two completely over Zoom. Yeah, I know, we did the same thing. Series A and B was pretty much over Zoom. And it's great to be able to do that efficiently. I think both sides of that transaction are happy about kind of this new efficiency, but I tell you, like nothing replaces, the face-to-face relationship you build with someone who's going to support your project and, participate in governance or, put up capital or, give you mentorship and advice. And so I spend a lot of my time in San Francisco, New York now, face to face with these folks, and it's always valuable. It's still worth the travel. So I would really encourage any other founders to really like get in face to face and make that time. Even if it's just like grab coffee for 45 minutes or, I did this in New York, every meal, grab a drink at night, like just reconnecting with folks that have been, supporters of our network and, asking for help, sharing stories, sharing concerns. I had lunch with one of our great investors that, I told him, some of the things that are just, kind of painful in the space right now. And, there's the sentiment in blockchain web3 right now is really tough. And, he gave me a lot of words of advice, like, hey, just because like, an investor might be selling, like, that doesn't mean like, you shouldn't take it personally. You shouldn't like, there could be some directive at the firm that, they can't hold whatever anymore. And so it's really valuable. I encourage everyone to do that. And then finally went over to Denver for East Denver, which is the largest Ethereum conference, might be the largest blockchain conference in the world. There were, depending on who you talk to, somewhere between 25 and 40,000 people there. So it was really incredible. They had this venue in Denver where they usually do the cattle auction. I'm not even sure I know what that means, but it's this huge venue kind of downtown Denver where, it was incredible. It was, John Poller is the founder of this conference. He also runs this healthcare health benefits collective called Opolis, Opolis, which is a collective that helps freelancers, independent workers get good benefits. Braintrust has actually partnered with them to help freelancers get better insurance rates. So John's a great guy. This conference is incredible. We were lucky enough to get a good speaking spot, kind of like right between Joe Lubin from Consensus and Vitalik Buterin. So I gave a talk about kind of the deteriorating crypto macroeconomic scenario, global macroeconomic conditions, and then how crypto might play a part in helping turn us around out of the recession and rebuild productivity and that kind of thing. So presentation went over like a lead balloon and with that room, but it was Friday night at like 8:00. So also tough time to try new content, but we're gonna do the presentation for our talent community and core teams later on. We'll throw a link into that. But anyway, it was a great conference. Really great again to be there in person, kind of showing up and meeting all the folks. There's tens of thousands of developers still working in this Ethereum ecosystem. Really incredible for a crypto winter. I've been through, it's my third winter now, and nothing like the last two. So really encouraging to see that. Anyway, so that's all I got. Again, these will be pretty short. I'll try to do them every week, and I'll bring in other lessons I learn every week, and then some of them are timely and some of them touch the news like this. But anyway, thanks for listening to this first one.